We don't like limitations on what we can do with our buildings, what we can do with rents. So we're investing into markets where there is no rent controls. The next thing is trade availability. Obviously, we are turning over units as tenants leave. We improve the units and have nice fresh units for people to move into. We don't want any problem in getting the trades in there to make that happen, because it would impede our rentability of that unit, thus affect our cash flow. So we need an abundance of trade availability. We need strong property management and business-friendly local and state governments. So those are really important to us. And so those are what we look for when we look at markets to invest in. Now, we're going to take a second. We're going to talk about tax-sheltered income and equity growth. And really what I'm going to do is I'm really going to focus here on three primary tax strategies. Now, the first thing that we're going to talk about is we're going to talk about depreciation, and then I'm going to talk about accelerated depreciation. So depreciation, I'll explain that. When we buy a building, we conduct a cost segregation study, and everybody, if you don't do that, you should do that, because what you need to do is, as soon as you buy the building or when you're in the process of buying it, you need to understand, how much are you paying for the building versus how much are you paying for the land. And what we were able to do in real estate is we're able to depreciate the building cost over the span of 27.5 years. And that's what the IRS, and I believe it's Revenue Canada as well. Up in Canada, I think you can do that there as well. But the U.S. for sure is 27.5 years. So we're able to depreciate our actual building cost, not our land, because land doesn't depreciate. There's nothing on there that wears down. But we're able to depreciate our buildings over the course of 27.5 years and get a nice deduction from our taxable income. So let me give you an example. Let's say that we all got together and we bought a building for $1.5 million, and the actual building value was $1 million. Thus, you paid $500,000 for the land. And we use the 27.5 years that the IRS allows us. We're able to reduce our taxable income by just over $36,000 per year, but you still get the money in your pocket. So if let's just say that your taxable income at the end of the year for your building was $36,000, and that's how much your taxable income was. Well, when you take into consideration your depreciation, which the IRS allows you to do, you reduce your taxable income by $36,000, so the amount that you pay in tax is zero. How fantastic is that? But yet you still got the $36,000 to put into your pocket, leave in the business, or go and use it as a down payment on another property or another investment. So it's a fantastic tool that we use day in, day out. Now, accelerated depreciation just advances that entire process that much quicker. So what we're able to do is we're able to take smaller items such as office equipment, laundry equipment, the washers and dryers, our legal fees, closing costs, and we're able to deduct those over the course of 3 to 5 years, not the 27.5 years. So we're able to take those deductions in the first 5 years. So what happens is when you invest in these buildings, your depreciable expenses are greater in the first 5 years than they are for the full 27.5. But it's great. Take it, because it's going to be putting some tax-deferred money into your pocket. Now, the next thing we'll talk about is tax-free refinancing. And basically, with your property increasing in value and your mortgage getting paid down, because tenants like to pay down your mortgage for you, that's part of the reason why we like the multifamily business, your mortgage is going to get paid down over the course of time, and we have the ability to refinance every 3 to 5 years and pull some of that money out that we've made in capital appreciation. And through this process, you as an investor will not be taxed on the amount you received that was delivered or derived from this refinancing process. So it's just truly another great benefit of investing in real estate. And the next thing is sell and perform a 1031 exchange. Now, this technique is not available in Canada, only in the U.S., and I got to tell you, it's just a fantastic tool if you're looking to buy and sell, buy and sell, buy and sell, and have some definitely tax-deferred capital gains. So with a 1031 exchange, what it allows us to do, it allows us to sell our apartment building and roll over all of our profits. So if we bought a building for $1 million and we sold it for 1.5, we have $500,000 in capital gains. Well, if your intent is to continue on and you like this business of buying and fixing and selling multifamily buildings, and you want to move on and do it again and again and again to duplicate your process over, you can do it, and you open up a 1031 exchange every time you enter into a sales contract in your building. And what happens is you put your profit into the 1031 exchange account, and then you get into another like asset purchase, and you pay no tax on the gain. And it's a fantastic opportunity to actually have deferral on your capital gains tax, and this can go on into perpetuity. You can do it for years and years and years, and this tool's been around in the U.S. for quite some time, and a lot of high net worth individuals, institutions use this advantage in the U.S. because you pay no tax on your capital gain, and just a great opportunity to have some tax deferral on your capital gain. So now what I'd like to do is I'd like to talk about 4 unique and profitable benefits that are really only available to real estate investors. And of course, the first one is going to be cash flow that we're going to talk about. Now with cash flow, of course, you've got monthly or quarterly net income from your property, or at least I hope you do. And the next thing is, of course, and your cash flow is derived from your gross rents less your operating expenses, capital improvements, and debt. And really, from a cash flow perspective, we're seeing returns anywhere from that 5 to 9% range on an annual basis for the B and C class assets, and that's really what you should be getting on your cash flow. The next thing is appreciation, and of course, this is the increase in the value of the property through increases in net operating income or capital improvements, or a combination of both. Now, appreciation, it's going to be realized at a property sale or refinance event. And typically, the largest gain on a transaction is through your appreciation. And through this process, you can safely achieve anywhere from 6 to 10% just on appreciation alone, with a 70 to 75% loan-to-value property. The next thing, advantage we've got in real estate, of course, is principal paying down your mortgage. And so, the monthly benefit to investors from reducing the loan balance, it's only realized at a property sale or refinance. And typically, a principal paydown will account for about 3 to 4% of an annual benefit per year on a property that's leveraged to 70 to 75%. And it's just a great thing when tenants want to pay off your mortgage for you, and that's one of the beauties of being in real estate. And the last major advantage to us, of course, is our tax benefits, and we'll talk about that in a little bit more detail. But real estate is really one of the most tax-advantaged asset classes. I think oil and gas has some good advantages, and I think farming as well. It's just they're tough to tap into to take advantage of. And with real estate, you can get some tax-free income. You can get some tax-free refinance capital back to you, and you got some tax-deferred capital gains that we talked about. And really, when you look at real estate, there is just so many tax advantages to investing in this asset class that really, with real estate, our worst case is really, in a lot of cases, it's the best case for other asset classes. So it's something that you really need to look at and understand, because it could assist you in whether or not you participate in this asset class. But and with regards to taxes, we're not tax professionals. Like, we've been around the space for a long time, and we kind of have the ways that we invest, and based on how our consultants say we should structure our deals from a tax perspective. But I really got to put a caution flag out there and say you really need to get your own tax opinion, because everybody's situation is just a little bit different. And so before you invest, we strongly recommend that you have somebody just take a look at it from a tax perspective as it relates to you. So if you're looking to invest, are you going to hold your investment personally? Are you going to hold it in a corporation? Are you going to hold it in an LLC? Foreign investors, you're going to want to have a quick, foreign tax consultation just to make sure that, you're not going to be put into a situation where you're paying double tax. And so it's just really important that you get your own tax advice. Now, with real estate, you can really shape your return to your objective. Now, if you're strictly looking at maximizing cash flow, you would look at a higher yield deal. If you're looking for more capital appreciation, you'd be looking at more of a kind of a value add play, where you can actually buy something, fix up the common areas, fix up the units, and then sell it. Maybe that's more of a capital appreciation play you're looking for, or maybe you're looking for a combination of cash flow and capital appreciation, which is really kind of right into our wheelhouse, and you'd be looking for, a leverage deal with a value add component. So there are a number of ways with multifamily to kind of shape your returns. And this, again, is a number of reasons why so many people right now are turning to this asset class, because it gives them a lot of flexibility. Now with stocks, which is more liquid and transactional, you'll have the ease of being able to cash out. However, you don't have the advantages, the tax advantages, and quite frankly, the returns that you can get through well-purchased, well-managed, well-located real estate. The 15 to 18% returns we're talking about are backed up by the National Association of Commercial Real Estate Investments Funds, which is NACRF, and the returns we are talking about here are typical, if done properly, with the right, with the right sponsor behind you, the guys that know what they're doing day in, day out. With the stock market, I believe the average annual dividend, including reinvestment, is between 6 and 7%. And so, I think for a lot of people, it's just really about getting access to the investment and being able to get into the